Right now, inside insurance company actuarial departments that most general aviation pilots will never think about and never visit, there are spreadsheets being updated with data that is going to affect what you pay to fly next year. Not what you pay for fuel, not what you pay for maintenance. What you pay just to legally have coverage on an airplane you already own, an airplane that might be running perfectly, that might have a fresh annual, that might have a brand new avionics upgrade sitting in the panel, and that is still, quietly, getting more expensive to insure every single renewal cycle, in some cases dramatically more expensive, because of factors that have nothing to do with your flying record, and almost everything to do with how old the airframe is, where the industry's actuarial math has shifted, and what's happening to the broader pool of insured aircraft around yours. This is the aging fleet insurance problem, and it's getting worse. Not in a slow, barely noticeable way. In a way that is showing up in renewal conversations happening right now at airports across the country, in a way that is pushing some owners to make decisions they never expected to have to make. Hangar a perfectly good airplane because the insurance cost no longer makes economic sense, drop coverage they need to keep their lender happy, or sell an airplane they love because the total cost of ownership crossed a threshold they can't justify anymore. And if you own a general aviation aircraft that's 20, 30, 40, 50 years old, or if you're thinking about buying one, this conversation affects you directly, in ways that are more specific and more urgent than the general noise about aviation costs tends to convey. Before we get into it, hit subscribe, because this channel is where we go deep on the financial mechanics of general aviation ownership, in a way that's actually useful to real owners making real decisions, not just broad strokes about how flying is expensive. If you want to understand what's actually happening to insurance pricing, why it's happening, and what your options realistically look like inside this environment, you need to be here for the breakdowns we're going to keep doing, and you don't want to miss what's coming. Let's set the stage, because you need to understand the structural forces at play before the specific numbers and specific situations start to make sense. General aviation in the United States operates around a fleet that is, by any honest measure, extraordinarily old. The numbers on this are not secrets, and they are not subtle. The average age of a general aviation piston aircraft in active operation in this country is somewhere in the neighborhood of 45 to 50 years old, depending on how you cut the data. 45 to 50 years old. These are not vintage curiosities being pulled out for airshow appearances. These are everyday working airplanes that people use for real cross-country trips, business transportation, flight training, and recreational flying. They are doing serious work inside an operating environment that, in virtually every other domain of transportation and machinery, would have retired them or replaced them many cycles ago. The fleet got this old for reasons that are completely understandable once you know the history, but the reasons don't make the insurance math any easier to work around. New certified aircraft became extraordinarily expensive through the 1980s and into the 1990s, driven by product liability exposure that was staggering in its impact on manufacturers, and production collapsed. When Cessna stopped building piston singles in 1986, a marker that still gets cited in aviation circles because of how jarring it was, the replacement pipeline essentially dried up. Owners held on to what they had. The fleet aged. Production liability reform eventually brought some manufacturers back, and the current landscape includes genuinely capable new aircraft, but the price of a new four-seat piston single has risen to a level that removes it from consideration for a large portion of the people who make up the traditional GA owner base. So the old fleet keeps flying, keeps getting older, and keeps presenting underwriters with a set of actuarial challenges that are getting harder to price profitably at rates that owners are going to want to pay. That's the foundational setup. Now let's talk about why aging specifically is the problem, because it's not simply that old airplanes break more, though that's part of it. The full picture is a lot more layered than that, and understanding each layer matters if you want to understand why your renewal looks the way it does. The first and most obvious layer is what the actuaries call loss history, which is a clinical way of saying they know exactly what happens when older airplanes are involved in accidents, and the data is not favorable in several specific ways. Older airframes carry engineering approaches, materials, and manufacturing techniques from their era, and some of those approaches produce failure modes that simply don't exist in the same way in modern airframes. Fatigue cracking in structures that were designed to certain stress tolerances with aluminum alloys that were the state-of-the-art in 1967 but aren't the standard anyone would choose today. Corrosion that builds over decades in ways that even rigorous annual inspections struggle to catch completely. especially inside structures that aren't easily opened up during routine maintenance. Rubber components, fuel bladders, seals, hoses, that have been replaced multiple times over the life of the airframe and whose reliability degrades in ways that are partly calendar dependent and not entirely captured by replacement intervals alone. None of this means a well-maintained 40-year-old aircraft is unsafe to fly. That's an important distinction to make clearly, because this conversation gets conflated with safety arguments that are more complicated and more nuanced than they appear at first. What it means for insurance purposes is that the statistical distribution of what can go wrong and how much it costs when something does go wrong looks different for a 50-year-old airframe than it does for something built in the last decade, and underwriters price that difference. They have to price that difference. If they don't, they lose money, and eventually they leave the market entirely, which doesn't help anyone. The second layer is parts availability, and this is getting more acute in ways that weren't as visible 5 or 10 years ago as they are today. When an airplane is damaged, not destroyed, just damaged in a ground incident, a gear up, a hard landing, a hangar rash situation, the cost to repair it depends enormously on what parts it needs and whether those parts are available in a reasonable time frame at a reasonable price. For an airplane model that's still in production or that was in production until recently and has a strong aftermarket support ecosystem, the repair path is generally clear. For a type that was produced for a decade or two starting 50 years ago and hasn't been in production since, the repair path can get murky fast. Insurance companies pay claims. When a claim happens, they're on the hook for the repair cost, and when that repair cost runs up, because a critical structural part has to be located through a salvage network, or sourced through a parts manufacturer if one even still exists for that application, or fabricated through the FAA's approved process, which is legitimate but not fast or cheap, the indemnity cost goes up. Underwriters know this from experience with previous claims, and they price that parts availability risk into the premium for airplanes where they've seen it happen. As more of the parts manufacturing ecosystem for vintage types has consolidated, as more salvage sources have been exhausted or deteriorated, and as the regulatory environment for approved parts fabrication has gotten more complex, the repair cost tail risk on some of these older types has gotten meaningfully worse from an actuarial perspective, and that flows directly into what you're quoted at renewal. The third layer is hull value, and this is one that catches a lot of owners off guard because it operates in a counterintuitive direction. You'd think that as your airplane gets older and worth less on the used market, your hull insurance cost would go down with it because you're insuring a smaller value. And to some degree that's true. You're not paying the same hull premium to protect a $40,000 airplane as you'd pay to cover a $400,000 one. But the relationship between hull value and total cost of ownership is more complicated than a simple percentage calculation, because liability coverage, the piece of your policy that covers what happens if someone gets hurt or killed, if property is damaged on the ground, if a third party brings a claim against you related to the operation of your aircraft, doesn't go down just because your hull is worth less. Liability coverage is where the genuinely large numbers live in aviation insurance. Hull claims hurt. Liability claims can be existential. A wrongful death claim arising from an aircraft accident, a serious injury claim from someone on the ground, a property damage claim involving a structure or another aircraft. These are the exposures that produce 7-figure and 8-figure settlements, and your liability coverage has to be sized to provide real protection at that level if it's going to mean anything. The cost to insure that liability exposure doesn't decrease materially just because your airplane was built in 1972 instead of 2012. Your airplane's age doesn't make the person injured less injured, and it doesn't make the legal exposure smaller. So what happens as hull value ages down is that the liability portion becomes a larger fraction of your total premium, and the math on insuring a low-value old airplane gets compressed in a way that makes it feel expensive relative to what you're protecting. The fourth layer is underwriter market capacity, and this one is critically important to understand because it's driving changes that feel sudden and personal, even though they're structural and systemic. General aviation insurance is not a huge, deep market with dozens of carriers competing aggressively for your business, in a way that keeps prices naturally low through competition. It's a specialized market with a limited number of serious underwriters who understand aviation risk well enough to price it, and that limitation matters enormously when market conditions shift. Over the past several years, the general insurance market, across home, auto, commercial property, specialty lines, has experienced a significant correction in pricing after years during which premiums lagged behind actual loss costs in many lines. Carriers that had been cross-subsidizing money-losing lines with profitable ones saw that model break down as catastrophe losses in property, as litigation trends in casualty, and as broad loss cost inflation all hit at once. The response across the industry was a pullback in capacity in lines perceived as unprofitable, combined with significant rate increases in lines where carriers stayed engaged. Aviation insurance is a specialty line with enough complexity and enough loss volatility that it attracts this kind of scrutiny in a tight market cycle. And the GA segment specifically, smaller premiums per policy, older assets, a more varied and harder to underwrite pilot population, has seen meaningful capacity reduction from carriers who decided the risk-reward no longer penciled out at the rates the market had historically supported. Fewer carriers competing for your renewal means less pressure on pricing from competition, which means rates go up. It's genuinely that simple, at a macro level, even if the specific details of your individual renewal feel more personal than that. Now let's get into what this actually looks like on the ground for owners in different situations, because the general forces are one thing, and the specific ways they manifest in real renewal conversations are another. Take a scenario that's playing out with real frequency right now. An owner who's had a Cherokee or a Cessna 172 or a Piper Arrow for 15 or 20 years, a well-maintained airplane, no claims history, a pilot who's done everything right from a risk management perspective, flying regularly, keeping current, perhaps even adding a rating or two over the years, opens their renewal and finds a number that's 20, 25, 30% higher than last year. Not because anything changed about them, not because they had a claim, not because their airplane has somehow become more problematic than it was 12 months ago. The number is higher because the carrier's book of business in this segment priced incorrectly on a loss-cost basis for several years running, and the correction is happening now, distributed across every policyholder in the pool, including the good ones. This is genuinely maddening from an owner's perspective, and the frustration is completely understandable. You did everything right. Your claims history is clean, your airplane is well maintained, and you're paying more anyway, because actuarial math doesn't sort you out individually from the aggregate experience of the broader pool of insured airplanes and pilots in your category. The only way to escape that pool's experience is to be in a different pool, which means finding a different carrier with a different book of business and different loss experience, which is exactly why shopping your renewal with a broker who specializes in aviation and has access to multiple markets is more important right now than it's ever been. But we'll come back to that. Let me walk through some of the specific aircraft categories and owner situations where the insurance cost acceleration is most acute, because the problem doesn't distribute evenly across the fleet. Aging twin-engine piston aircraft are taking some of the hardest hits in the current market cycle, and the reasons for it layer on top of each other in ways that compound the problem. Twins are complex. They're higher performance. They're statistically associated with accident modes that carry high loss costs when they go wrong, because the scenarios most dangerous in a twin, engine failure at critical phases of flight, loss of control following an asymmetric power condition, tend to produce serious accidents rather than minor ones. Add in that a large portion of the twin fleet is extremely old, consisting substantially of airframes built in the 1960s and 1970s, when twin ownership was the aspiration of a larger portion of the pilot population than it is today, and you get a situation where the underwriting math has gotten punishing. Owners of well-maintained vintage twins with excellent flying records are seeing renewal numbers that sometimes cross into territory where the annual insurance cost approaches or exceeds the hull value of the airplane itself, which is a number that makes the ownership calculation very difficult to sustain. The twin fleet situation is compounded by a pilot demographic issue that overlaps with the aircraft age problem. Many of the pilots who own and fly these older twins are themselves experienced aviators who've been flying for decades, which is in many ways a positive thing from a skills standpoint. These are serious pilots with real experience, not low-timers stumbling into complex aircraft. But the same demographic wave that's pushing experienced pilots toward medical certificate challenges and potential certificate loss is concentrating the twin owner base in an age cohort where insurers have become more cautious, where minimum hours requirements have gotten stricter, and where the conversation about whether a pilot's ongoing currency and proficiency is insurable at a given rate level has gotten more pointed. The pilot age factor and the aircraft age factor are hitting the same set of owners at the same time, which is producing some very difficult conversations at renewal. High-performance single-engine retractables are experiencing a version of the same problem, though at somewhat different price points. A Mooney, a Bonanza, a Cirrus SR-22 that's now gotten into the 12 to 15-year-old range. These are capable, sophisticated airplanes that were expensive when new and still hold meaningful value on the used market. They also carry insurance requirements that have gotten noticeably more specific about minimum hours in type, about recurrent training completion, and about the pilot's overall flight activity profile. An owner who bought one of these airplanes during the pandemic buying surge perhaps stepped up from a simpler airplane faster than they might have otherwise because the used market dynamics at the time made it feel like the right moment, and who has since found themselves flying fewer hours than they initially planned. That owner is walking into their renewal in a position that's harder to defend from an underwriting standpoint than they might have anticipated. Their hours in type may not have grown the way the original underwriting assumed. Their recurrent training may have slipped, and in a market where underwriters have gotten stricter about exactly those factors, the renewal conversation is less comfortable than it was when the policy was first written. The training aircraft segment has its own version of this problem that affects owners differently, but is worth understanding because it touches the pipeline into flying in ways that matter to the whole ecosystem. Flight schools operating vintage training fleets, and there are a lot of them because a Cherokee 140 or a 172 from the mid-1970s that's been maintained continuously is in many ways an excellent training aircraft that does the job it needs to do, are seeing insurance costs per aircraft in their fleet climb at rates that the per-hour revenue those aircraft generate is struggling to keep up with. When insurance is a meaningful and growing fixed cost per airplane, regardless of how many hours that airplane flies, the utilization calculus gets harder. Schools are facing choices between raising hourly rates to a level that covers the insurance cost without assuming very high utilization numbers, or running the airplane hard enough to spread that fixed cost over more hours, or making difficult decisions about which airframes to retire from the fleet and which to keep. All of those choices have downstream effects on training costs for students, on the school's competitive position, and ultimately on how many new pilots enter the pipeline each year. Let me spend some time on the hull value problem specifically, because it's generating a particular kind of owner frustration that deserves a careful treatment. When you have an airplane that's worth, say, $60,000 on the current used market, and the annual premium for a comprehensive policy, hull plus solid liability limits, is running $5,000, $6,000, $7,000 annually, you're looking at a cost-to-value ratio that doesn't exist in any other form of vehicle insurance most owners are familiar with. Your car insurance is not 10% of your car's value annually. Your home insurance is not 10% of your home's value annually. Those comparisons feel unfair to aviation owners, and in one sense they are, because the risk profile of operating an aircraft and the cost structure of the insurance market are genuinely different from those other lines. But the comparison still stings, and it still drives real owner behavior around whether to maintain full coverage or drop hull coverage entirely and go liability only, which is a decision that has real financial risk implications that aren't always fully thought through before the decision gets made. The drop to liability only is something that's happening more frequently as hull values age down and premiums stay elevated, and it's worth walking through the actual implications clearly, because the decision isn't as straightforward as it might appear when you're staring at a renewal invoice that feels too high. If you remove hull coverage from your policy and have an accident that damages or destroys your airplane, you absorb that loss entirely. If your airplane is worth $40,000 and you've been carrying hull coverage that costs you $1,800 a year, dropping hull coverage saves you that $1,800 annually, and if you go 7 years without a hull claim, you've come out ahead. That math makes dropping hull look rational. But a hull loss doesn't happen after a predictable interval. It happens randomly. And if it happens in year 2 after you've dropped coverage, you've just lost $40,000 to save $1,800. Most general aviation pilots do not have a reserve fund sitting specifically to absorb a total hull loss if one happens, which means the hull loss becomes a genuine financial disruption rather than a covered insurance event. There's another piece to the liability-only decision that doesn't always get considered, which is what happens when a lender is involved. If you're financing your aircraft or refinancing against it, your lender almost certainly requires hull coverage as a condition of the loan, because they have a security interest in the asset. Dropping hull coverage without notifying your lender doesn't just create financial risk for you in a loss scenario. It puts you in technical default on your loan agreement, with all the complications that can follow from that. Owners who make the drop-to-liability-only decision to manage insurance costs without thinking through the lender angle can create a problem for themselves that's worse than the insurance cost they were trying to escape. Now let's talk about the pilot age and experience component of this, because it deserves its own careful treatment, separate from the aircraft age issue, even though in practice they often affect the same owners at the same time. Underwriters have gotten more systematic and more specific about how they evaluate pilot age in their pricing, and the shifts in the last few years have been more pronounced than most owners expected when they were younger and didn't think it would matter to them. The data that underwriters work from shows that accident rates begin to rise in certain pilot cohorts at certain age thresholds. Not universally, not predictably at the individual level, but statistically, at the population level, in ways that affect how the book of business performs. Actuaries care about the book of business, not about you specifically, which is why it feels impersonal and unfair at the individual level, even when it's actuarially defensible at the aggregate level. What this has translated into in practice is that pilots crossing certain age thresholds, and the specific thresholds vary by carrier, but you start to see them show up meaningfully in the 60s and more forcefully in the 70s, are being asked for more from an insurability standpoint. More required hours annually to maintain coverage, more structured recurrent training, specifically with a certificated instructor, rather than just a flight review buddy. More specific currency requirements documented in ways that the underwriter can verify at renewal, rather than simply attestation. Some carriers are implementing mandatory simulator evaluation requirements for pilots above certain ages in higher performance aircraft. Some are restricting solo flight operations and requiring a qualified co-pilot for certain operation types. For a pilot who's been flying for 30 or 40 years, who learned to fly when these requirements simply didn't exist in this form, who has a genuine and hard-won depth of experience in the air, being told that their age is now a pricing factor or a coverage restriction feels deeply personal and often genuinely insulting. The frustration is understandable. The data that underwriters are responding to is real. Those two things can both be true simultaneously, which doesn't make the conversation easier, but does make it more navigable if you understand what's actually driving it. The medical certificate piece of this overlaps directly with the insurance conversation in ways that owners don't always connect explicitly. The third-class medical certificate that most private pilots need to exercise their privileges requires passing a physical that becomes progressively more likely to surface something as pilots age. And the third-class standard specifically is one that many pilots eventually find themselves at risk of not meeting. The development of Basic Med, which allows certain pilots to fly without a traditional medical certificate under a different regulatory framework, was a genuine help to many pilots who'd otherwise have had their flying careers end by a medical examiner's finding. But the insurance implications of Basic Med versus traditional medical certification are not always identical, and some underwriters are more cautious about pilots operating under Basic Med provisions in certain aircraft categories than they are about pilots holding a current traditional medical certificate, because the medical vetting process is different and the ongoing verification structure is different. If you're managing a situation where you're flying under Basic Med and your renewal is coming up, having a specific conversation with your broker about how your current carrier views that versus alternatives that might view it more favorably is worth the time, because this is one of those areas where the difference between one underwriter's position and another's can be significant, and most owners don't realize there's meaningful variation to navigate until they've already been given a difficult number from their current carrier. Let's talk about what the insurance market actually looks like for owners trying to navigate this right now, because the picture varies more than the general narrative of everything is getting more expensive would suggest, and understanding the variation is where the practical value is. The first thing to understand is that the GA aviation insurance market is genuinely not a commodity where every underwriter is looking at your submission and arriving at essentially the same number through slightly different processes. There are real, meaningful differences in how different carriers approach different aircraft types, different pilot profiles, different geographic regions, and different use cases, and those differences can translate into premium variation that's worth pursuing through a specialist broker rather than just taking the first renewal number you're given as the definitive answer to what your insurance costs. Carriers specialize. A carrier that has a strong book of business in vintage piston aircraft and has developed real underwriting expertise in that segment may price a 40-year-old Cherokee or Bonanza more favorably than a carrier whose primary aviation book is built around turbine aircraft and who applies more conservative assumptions to the piston fleet they see less of. A carrier who's had good loss experience with a particular type, say Cessna 182s or Piper PA-28s, over a long book has more confidence in their loss assumptions for that type and may price more competitively than a carrier who's had worse experience or who has less data and is therefore building in more conservatism to their assumptions. The implication is that you are almost certainly leaving money on the table if you're not shopping your renewal across multiple carriers who are actively writing GA business, through a broker who knows which carriers are currently competitive for your specific combination of aircraft type, age, use, and pilot profile. This is not a novel observation. Every insurance professional will tell you to shop your coverage, but it's more urgently true right now than it's been in at least a decade, because the market has been moving fast, and individual carrier positions on specific risk categories have shifted meaningfully, and not all in the same direction at the same time. Your current carrier may have pulled back on the specific combination you represent, while a different carrier has moved toward it. You won't find out without asking. The second thing to understand is that how you present yourself as a risk matters more now than it did when underwriters were competing more aggressively for market share and were more forgiving about submission quality. A broker who knows how to structure your submission, how to present your flying history, your training record, your aircraft maintenance history, your operating practices, in a way that gives underwriters the best picture of your actual risk profile is genuinely worth paying for through the value of the premium difference they can generate. This isn't about misrepresenting anything. It's about making sure the true picture of you as a low-risk, well-trained, currency-conscious pilot who takes maintenance seriously comes through clearly, rather than getting lost in a generic submission that doesn't differentiate you from the average of your category. Third, training and currency are more directly and more explicitly connected to what you pay than they used to be, and treating them as insurance cost management tools rather than purely as flying quality investments is worth doing. Completing an organized, structured, recurrent training program, a WINGS program, a WINGS phase, an organized type-specific recurrency course from one of the organized training providers, a simulator evaluation at a recognized center, and being able to document that completion at renewal is not just good for your flying. It's money in some cases. Underwriters who are specifically looking at recent training completion as a rate factor will price you differently with documented recurrency than without it. Sometimes meaningfully so. If you're paying several $1,000s annually for insurance, a few $100s invested in a well-structured recurrent course that you can document might return more than its cost in premium reduction at your next renewal, while also making you a better pilot. That's a genuinely good deal in every direction. There's a specific subset of the training investment conversation that's worth highlighting, which is type-specific training programs that have formal underwriter recognition. Some aircraft type clubs and manufacturer training programs have established relationships with specific underwriters where completion of their curriculum is recognized in the underwriting process as a meaningful risk mitigation factor. The Bonanza, Piper, and Cessna type clubs, among others, have established training programs that some underwriters view favorably in ways that generic flight review documentation doesn't produce. If you own a type that has an active owner organization with a recognized training program, and you're not already involved in that ecosystem, the insurance benefit alone, before you even count the flying quality benefit, is worth looking into. Let me talk about the maintenance documentation piece of this, because it's less often discussed in the insurance cost context but matters more than most owners realize. An underwriter assessing your submission is doing their best to form a view of how well maintained and how reliably operated your aircraft is, based on what they can see. They can't inspect your airplane directly. They're working from your submission, your claims history, and what the market broadly knows about the type you're flying. Within that constraint, the quality and completeness of your maintenance records is one of the most direct signals available to them about the care and attention your aircraft receives. An airplane whose logbooks tell a clear story of consistent annual inspections completed on schedule, ADs addressed promptly, unscheduled maintenance events documented with clear squawk descriptions and resolution documentation, and an established relationship with a qualified maintenance facility is, in the underwriter's framework, a lower-risk aircraft than one whose maintenance history is fragmentary, inconsistently documented, or shows gaps that require explanation. This matters specifically for aging aircraft, where the underwriter's baseline assumption about maintenance quality and reliability may be more skeptical than it would be for a newer airframe. Demonstrating clearly through strong documentation that your particular aging aircraft is an exception to whatever average assumptions the underwriter starts with is worth doing deliberately. If you're heading into a renewal cycle and your maintenance records are disorganized or incomplete, spending some time with your mechanic to get the documentation cleaned up and organized is genuinely worth doing before your renewal conversation, not as an afterthought after. There's a related point about aircraft improvements that sometimes catches owners by surprise in the insurance context. Installing a modern avionics suite, a glass primary flight display, a capable GPS navigator, an ADS-B-compliant transponder, an autopilot with envelope protection, in an older airframe is, in many ways, a safety improvement. The pilot has better situational awareness, better navigation capability, more terrain awareness, and in some configurations, protection against certain types of controlled flight into terrain scenarios. That safety benefit is real. But whether it translates into insurance savings is more complicated, because the installation of high-value avionics in an old airframe also raises the hull value of the airplane from the insurer's standpoint, and a higher insured hull value means higher hull premium. Whether the risk mitigation credit for the improved avionics exceeds the additional hull premium for the higher stated value depends on the specific situation and specific underwriter, and it's worth discussing explicitly with your broker, rather than assuming the improvement will either help or hurt without checking. Hangar versus tie-down is worth discussing explicitly too, because it's a factor underwriters consider, and because the cost differential between hangared and tie-down storage is sometimes framed purely as a convenience issue when it has real insurance implications. Aircraft that are hangared are protected from weather-related ground damage, hail, wind events, debris impacts, in ways that tie-down aircraft are not. Underwriters know this and may price it differently, particularly in geographic regions and at airports, where weather exposure risk is elevated. If you're on the margin about whether to pay for hangar space versus accepting a tie-down, the insurance implications of the choice are worth asking about explicitly, because in some situations, the premium differential more than pays for part of the hangar cost. Now I want to spend some time on what options owners actually have when they're facing a premium increase that's genuinely difficult to sustain, because the reality is that shop around and train more isn't always enough to bridge the gap between what insurance costs and what an owner can reasonably afford to pay, and the harder choices deserve honest treatment. Some owners are making the decision to reduce coverage scope as a cost management tool, and it's worth walking through what that actually means in practice. We talked about dropping hull coverage earlier. Another version of this is reducing liability limits to levels that are genuinely inadequate for the exposure involved in operating an aircraft, and this is a choice that can feel rational when you're staring at a premium invoice, but that leaves you with a level of personal financial exposure that most owners, if they thought through the scenario carefully, would not accept as rational. $1 million of liability coverage on an aircraft sounds like a lot of coverage, until you're in a scenario where a serious accident causes multiple injuries or a fatality, and the legal exposure runs well past that limit into your personal assets. Reducing liability limits to manage premium costs is trading future financial risk for current cash flow, and it's a trade that the insurance professionals I've talked to consistently describe as one of the highest risk choices an owner can make. A more defensible cost management approach for some owners is adjusting how they use the aircraft in ways that reduce the risk profile they're presenting to underwriters. This can mean operating under more limiting conditions, hard weather minimums that keep you out of challenging IMC, geographic restrictions that keep you away from complex airspace or terrain environments, limiting the types of approaches you fly in actual instrument conditions, and documenting those self-imposed operating restrictions in a way that you can communicate to underwriters as genuine constraints on how the aircraft is used. Some carriers will price meaningful, documented operating limitations more favorably than an unrestricted policy. And if the restrictions actually match how you use the airplane anyway, you're not giving up real capability to capture the savings. There's a version of this conversation that's particularly relevant for aging owners who are genuinely beginning to self-limit in ways that reflect changing personal risk tolerance or changing physical capability. If you've found yourself naturally avoiding certain conditions, naturally not flying beyond certain ranges from your home base, naturally bringing along a safety pilot more frequently, and you're willing to formalize those patterns as underwriting conditions, that conversation with your broker about how it might affect your renewal is worth having explicitly. It won't always produce a dramatic result, but in some situations it can help hold premium down while also representing an honest picture of how you're actually flying. The co-ownership and flying club structure is getting a second look from some owners as a cost management tool, and it's worth understanding both the insurance implications and the practical dynamics. When multiple owners share an aircraft, the per-owner insurance cost shares out, which can make coverage economically viable for individual owners who might struggle with the full premium alone. But co-ownership insurance arrangements require careful attention to how the policy is structured, which pilots are named, and with what coverage provisions. What happens when one co-owner has a loss event, and how the policy responds to the full range of owners' flight activities. A co-ownership arrangement with an informal insurance setup that hasn't been reviewed by a knowledgeable aviation insurance broker is a potential disaster waiting to happen, because the gaps in coverage that seem unlikely to matter can become extremely consequential in the exact scenarios that lead to serious losses. If you're going down the co-ownership path as a cost management strategy, get the insurance structure right from the start, rather than trying to fix it after a problem has already revealed the gap. There's a broader strategic point about fleet decisions for owners who own multiple aircraft or who are deciding between upgrading from one aircraft to another. The insurance environment that we've been describing is not uniform across all aircraft types, and making intelligent choices about which type you're in, which type's insurance market is well supplied with competing underwriters, which type has strong owner organization training programs with underwriter recognition, which type has a reputation for being maintained and flown by a safety-conscious owner community, is a legitimate part of the aircraft selection calculus. Two airplanes with similar purchase prices and similar capabilities can have insurance costs that differ significantly because of how the underwriting market views them specifically, and if you're making a transition decision, running real insurance quotes on specific alternatives before you commit to a purchase is much smarter than buying first and discovering the insurance picture after. Let me spend some time on where this is heading, because understanding the directional trend matters as much as understanding the current state. The underlying forces driving the aging fleet insurance problem are not short-term or cyclical in a way that suggests they'll naturally resolve quickly. The fleet is going to continue aging because new aircraft production volumes are nowhere near the level required to meaningfully shift the average fleet age on any timescale under a decade, and new aircraft pricing is such that the buyers who would naturally replace old airplanes with new ones are still facing numbers that make the used fleet the dominant choice for most of the owner population. Parts availability for the oldest types in the fleet is going to continue getting thinner, not better, as more salvage sources are exhausted and as the remaining parts manufacturing ecosystem for vintage types continues to consolidate. The pilot population demographic wave isn't reversing. If anything, the age distribution of certificated pilots with enough experience to be in the market for the kinds of aircraft that generate the most complex insurance conversations is skewing older over time, not younger. These are long-duration structural trends, not temporary disruptions. The insurance market capacity picture is somewhat more variable because insurance market cycles do move, and there have historically been periods of broader competition for aviation insurance business that have provided meaningful relief from the rate environment of tighter cycles. A loosening of capacity could, in a future cycle, bring more competitive pricing to segments that are currently underserved and expensive. But betting on that cycle turning quickly, or planning your ownership decisions around an expectation that the insurance environment will meaningfully improve in the near term, seems optimistic, given where the structural fundamentals are pointed. What is more likely to evolve in interesting ways is the underwriting technology and risk evaluation approach that carriers use, because this is an area where the insurance industry broadly is investing, and aviation specifically has some characteristics that make it amenable to better data-driven underwriting than the relatively blunt instruments historically used. ADS-B-out requirements, which are now essentially universal for GA aircraft operating in the airspace where most flying happens, mean that there is, for the first time in the history of GA insurance, a growing database of actual flight track data for the majority of the insured fleet. That data tells a story about how and where aircraft are actually being flown, how high, how far from airports, what weather conditions they're flying into, based on correlation with weather data, What time of day? What geographic exposure? That is potentially extremely informative for underwriting individual risk, rather than relying entirely on category-level actuarial assumptions. A handful of insurers are beginning to think seriously about how to use this data in underwriting in ways that could benefit pilots whose actual flying patterns represent a more conservative risk profile than the broad category assumptions suggest. A pilot who flies frequently, stays close to well-equipped airports, avoids marginal weather conditions religiously, and demonstrates consistent patterns of safe operation visible in their flight track data is, in principle, a better risk than the average of their actuarial category, and if that can be demonstrated through data rather than simply asserted, some underwriters may be willing to price it. This is not happening at scale yet in the GA market, but it's a direction that could, over a medium-term horizon, provide real relief for pilots who've been feeling unfairly penalized by category-level pricing that doesn't reflect their individual discipline. It's worth watching, and it's worth mentioning to your broker if they're positioned to access carriers who are moving in that direction. There's a parallel development in the pilot monitoring technology space that's adjacent to this. Electronic logbook platforms that create a verifiable, consistent record of actual flight activity, not just self-reported total time, but documented, time-stamped, GPS-verified flight activity, are creating a more defensible paper trail for pilots who want to demonstrate recency, currency, and consistent activity at renewal. An underwriter asking for evidence of recent flight activity gets a much more compelling answer from a pilot who can pull up a verified digital logbook showing a well-distributed flying pattern over the past 12 months, than from one presenting a handwritten logbook whose entries are harder to independently verify. Getting your logbook into a platform that creates this kind of defensible time-stamped record is worth doing regardless of insurance benefits, and the insurance benefits are increasingly a real additional reason to do it. Let me come back to the practical takeaway dimension of this, because the goal isn't just to understand the problem, it's to give you tools to navigate it more intelligently than the average owner who just accepts what they're quoted and doesn't understand why the number is what it is. The single most important thing you can do in this environment is build a real relationship with an aviation insurance broker who specializes in general aviation and who has meaningful market access, meaning they place policies through multiple underwriters who are actively writing GA business, not just one or two. The difference between working with a specialist and going through a generalist broker who writes a little aviation on the side is significant. And it's getting more significant as the market has gotten more differentiated and the need for advocacy in the underwriting process has grown. Your broker should know your aircraft type, should have experience with other pilots in similar situations, should understand which carriers are currently competitive for your specific combination of aircraft, use, and pilot profile, and should be able to articulate a strategy for how to position your renewal to maximize competitiveness, rather than just submitting what you gave them last year with updated dates. If you don't have a specialist broker relationship and your current experience is renewing with whoever you started with years ago without shopping, that's worth changing. The process of getting comparative quotes doesn't commit you to anything and costs you nothing but some time, and the information it generates is genuinely valuable even if you end up staying with your current carrier, because you'll know whether your current pricing is competitive or whether you